Credit spreads are tight in general, but relative valuation starts to look more attractive compared to the global peers in both the developed and emerging markets. We continue to like the short-dated Chinese property as a carry play, with most of these offshore-listed developers under our coverage still running adequate liquidity with much improved short-term debt coverage due to the continued strong contracted sales and effective terming out of the debt maturity profiles in recent years. We also like selective regional bank sub-papers with decent spread pickup as one moves down the capital structure of some stable banking issuers, and corporate perpetual bonds with high step-up features that will likely to be called in near term. We also like to explore some non-dollar credit opportunities as a diversified play, such as INR, IDR, or CNH dim sum bonds with attractive after-tax adjusted yield of around 4 to 7%, shorter maturity profiles, and stable currency backdrop owing to the improved fundamentals and consolidated dollar trend. One can also look into selective exchangeable debts post the restructuring event with some sound underlying asset quality. We believe investors would prefer to own bonds at the bottom of the credit cycle with strong capital upside potential than chasing expensive high-yield bonds which are trading rich and riding at the later stage of the cycle. I expect the demand for high-income products remains strong under the low inflation and benign market volatility environment. It is very hard to project a meaningful shift of the current interest rate path, with rates likely to stay where they are for an even longer period of time. Hence, the carry strategy continues to be the preferred choice of investment. Most of the risk factors that currently exist in the market are more of the short to medium term noises than a real game changer, with little signs of systemic risk being established, including the political breakdown in LATAM and Middle East, the ongoing China deleveraging move, and the central bank tapering, which we expect to be a gradual adjustment process with increased runoff cap of up to 50 billion per month, and thus requires many years to complete. There's also need for balancing the anticipated slowing demand from tapering against the pickup in supply from the future fiscal stimulus funding plan. They may also need to consider the other central bank tapering strategy to assess the real impact on the dollar local market. Unlike other high-yielding credit strategies, the high-income strategy focuses heavily on countries outside China. We will continue look to buy on dips whilst focusing on bottom-up selection to avoid getting trapped with names on rising signs of defaulted risk. Besides optimizing the risk-adjusted carry for the portfolio, our aim is to maximize the capital gain opportunity by adopting a more flexible approach to credit investment in both the dollar and the non-dollar credit markets. We like to take advantage of the different credit cycles along the credit spectrum from a well-diversified pool of issuers with different credit quality and sector backgrounds in order to mitigate the idiosyncratic risk of any particular issuer within the portfolio.